All right, let's get right into it. Mastercard's Q3 numbers are out, and while the headlines all look pretty good, a lot of people are looking at the wrong thing. We're going to cut through all that noise and focus on the one number that really tells you everything you need to know about this stock right now.
So here's the deal. You've probably seen the headlines about slowing payment growth. And yeah, that's happening. But that is not the real story here. The number you really need to be paying attention to is one that jumped, get this, 25%. And that, right there, changes the entire investment case.
Okay, so first things first, let's just quickly look at the headline numbers. And, on the surface, everything looks pretty good. Another solid beat for Wall Street. But we're not here for the surface level stuff, are we? Let's dig in. All right, check this out. Net revenue up a really strong 17% to $8.6 billion. Adjusted earnings per share also up a healthy 13%. Great. But then you get to that last line, gross dollar volume. That's basically all the money flowing through their network. It's up 9%. And, 9% growth is fine. But this is exactly where the old story starts to fall apart.
And that brings us to the main event, the big concern for anyone who's maybe a little bearish on the stock. They're looking at Mastercard's bread and butter, that massive global payment network, and they're seeing a trend that's hard to ignore.
And this chart, wow, it just lays it all out, crystal clear. Look back at Q3 of last year. Growth was running hot, over 10%. We had a bit of a pop in Q4, but since then, it's been a clear step down. 9.2, 9.0, and now 8.7%. The trend is it's undeniable. The main engine is definitely slowing down. So let's be real. For a premium growth company like Mastercard, seeing your core business decelerate, that's a big deal. It's a red flag. And honestly, if this is all you looked at, you'd probably be thinking, maybe it's time to sell. But if you did that, you would be missing the most important part of the story.
Okay, now this is where things get really, really interesting. Because what you have to understand is that Mastercard isn't just a payment company anymore. Not by a long shot. For years, they've been quietly building this other business, a whole new engine. And that engine, it is absolutely roaring to life.
And boom, this slide right here tells you everything you need to know. It's the tale of two Mastercards. On one side, the payment network, growing at 12%. Respectable, for sure. But look at the other side, value-added services, growing at a staggering 25%. That is the number we talked about at the top. It's growing more than twice as fast. And, this is crucial, it's a higher margin business. This is the new growth story.
So what are these value-added services? Well, think of it as all the smart stuff they sell on top of just processing a transaction. We're talking about high-tech cybersecurity, AI fraud detection, and digital identity tools. They help businesses with loyalty programs and give them deep market insights. It's not just about moving money anymore. It's about providing intelligence, and that kind of business is sticky.
All right, but a good analysis never just stops to the top line, right? We've got to see how it all flows down to the bottom line. So let's talk about taxes for a second, because something pretty significant happened there this quarter.
Check this out. The company's effective tax rate shot up to 21.5%. Now, to put that in perspective, a year ago it was only 15.6%. That is a huge jump. A 6 percentage point hike in your tax rate is a direct hit to your profits. So the big question is, why?
Well, the answer is this new global rule that just kicked in called the Pillar 2 Global Minimum Tax. It's a big international agreement, and the goal is basically to make sure massive companies pay at least a 15% tax rate wherever they operate. For a company as global as Mastercard, this isn't a one-time thing. This is their new reality. Their tax rate is just going to be higher from now on.
Okay, so let's pull this all together. What do we have? We've got the core business slowing down, we've got this incredible services business that's on fire, and we've got a new, permanently higher tax rate. So, what's the final verdict for someone looking at this stock?
It all comes down to one fundamental question, really. Which story do you believe in? The story of the slowdown, or the story of a brilliant strategic pivot? Let's lay out the bull case and the bear case, side by side. So the bears, their argument is pretty straightforward. They see that slowing payment volume, they worry about the economy, and they think the core business is just going to keep getting weaker. Makes sense. But the bulls, they see a completely different company. They're laser focused on that 25% services growth. They say, look, Mastercard isn't just a payments company anymore. It's becoming a data and security powerhouse that doesn't live or die by how much people swipe their cards.
And hey, you don't just have to take my word for it. Let's look at what the CEO himself, Michael Miebach, said.
He comes out and says, sure, spending was healthy, but then he immediately pivots to the robust performance of our differentiated services. The message from the top is crystal clear. They know where the future of the company is, and they're pointing investors right at it.
So here's the big takeaway from all of this. If you're still analyzing Mastercard just by looking at how much people are spending, you're playing an old game. That's not the critical question anymore. The only question that really matters now is this. How fast can that services business grow? Can that 25% growth engine become the main story? Because that's the number. That's the one number that will define this company's future.